Business value. Intangible assets. The concept of business value is somewhat simplified in the examples that we've discussed, as a business may also have intangible assets which contribute to its value. Intangible assets may include patents, trademarks, customer contracts, goodwill, and more. Intangible means something that is not physical and cannot be touched. Furniture and computers are tangible assets. They have physical form. Assigning value to intangible assets can be subjective, but generally equates to the value of what the intangible asset could be sold for if it had to be sold. This means that there has to be a reasonable expectation that a buyer can be found that is willing and able to purchase the intangible asset at the price set. However, sometimes intangible assets are valued differently based on generally accepted accounting principles. This is an advanced topic beyond the scope of this lesson, but is noted here to help frame the balance sheet. Let's review another example. Notice that the intangible assets, the patents and customer contracts, have been added to the balance sheet. So in the first example, we have cash of $8,000, furniture of $1,000, and patents worth or valued at $2,000. That's $11,000 in assets, a $7,000 bank loan that is still owed, for a difference of $11,000 minus $7,000 equals $4,000 in equity. In the second example, we have cash of $12,000, land of $10,000, and customer contracts valued at $2,000. So that's $24,000 in assets, and a bank loan of $12,000 for a difference of $12,000 in equity. Tangible assets. Another element that affects business value is the value of tangible assets on the balance sheet. The value shown for assets is not the original purchase price, but the depreciated value of the asset. Depreciation is also an advanced topic, but it generally means that most assets will lose value over time. And so the balance sheet should properly reflect this change in value. For example, a computer may cost $900 brand new today, but if you tried to sell that computer in 1 year, you may only get a few $100s for it. The balance sheet should show the computer at its reduced value. Let's review this table. Notice that the value of the computer has changed from year 1 to year 2 on the balance sheet because it has depreciated. So in year 1, we have cash of $8,000, which is the same that we have in year 2. But in year 1, the computer was $900, and in year 2, it had depreciated down to $400. The liabilities are the same at $7,000 each. So everything being the same, nothing has changed in this business except that the value of the computer has depreciated over time from $900 to $400. That's a loss of value of $500. You can see that the equity or total value of the business as represented by the balance sheet has changed from $1,900 down to $1,400, which is the change in value of the computer. BusinessXP is the fastest and most inspiring training ever invented for future business leaders and entrepreneurs. Discover game-based experiential learning at business-xp.com.